Earlier this morning, NYSE parent company Intercontinental Exchange released the October Mortgage Monitor, which provides the latest data and analytics across the housing market. Andy Walden, ICE's head of mortgage and housing market research, joins me in studio with more. Andy, good to see you.
Thank you for having me. Appreciate it.
Yeah, of course. Always good to see you in studio. And according to this latest research, we are seeing the best home buying affordability since early 2023. What is driving that?
Exactly right. And it's a couple of different things. One is improved interest rates. We're at our best level since about this time last year. The second is softer home price growth that's allowing incomes to catch up, otherwise known as real home price declines. You put those two things together and we're seeing some of the best affordability that we've seen in 2.5 years.
Certainly probably good news to our viewers. Good news on a broad level. Which markets are still stretched though, and why is that?
And really nationally we're still stretched as well, right? It still takes about 5 percentage points more of the median income to buy the median home compared to long run averages. Midwestern regions of the country looking better. When you get outside kind of the western U.S., so Colorado West, especially along the western coast of the U.S., still extremely stretched. Los Angeles is the poster child there. Typically takes about a third of your income to afford the average home in L.A., currently closer to 2/3, so still very stretched out there. Here in New York City, still takes about 16 percentage points more of the local income, and then some coastal markets in Florida as well. So you look at those more expensive regions of the country still stretched. Midwest looking a little bit better from the affordability standpoint.
Well, as rates have come down a bit these past few months, are you seeing more homeowners try to refinance and take advantage?
We really have, especially over the last 2 to 3 weeks. We've seen a pop in refinance activity. The number of folks that could benefit from a refinance has jumped from 2 million a few weeks ago to about 3.1 million now. You've seen rate and term refinances really pop over the last couple of weeks. So it shows signs that as interest rates ease, there's a lot of homeowners out there waiting to kind of jump in and improve those rates and monthly payments.
Now, according to your data, how much do rates need to drop before you think people really can look to refinance?
It's a good question. We typically look at a 0.75% threshold, right? So about 75 basis point reduction. That's for the average homeowner, and that's where you start to see it pick up. If you have a higher loan balance, it takes a little bit less of an interest rate improvement to make sense, right? So 0.25% in some cases, 0.5% if you're somebody in a jumbo mortgage or in an expensive city center. If you're more in the Midwestern region of the country, lower loan balances, maybe it takes you a full 1.5%. You really look at, how long is it going to take me to recover the cost to refinance? What is that cost up front? What am I saving every month? And you kind of do the math from there.
What do you see when it comes to annual home price growth?
Yeah, we're seeing a few different things, right? First of all, the first 8 months of this year has been very soft. So you've seen annual home price growth go from 3.5%, slightly above that at the beginning of the year, down to about 1% by the time we got to August. From that point forward, interest rates have dropped a little bit. Sellers had started to back out of the market a little bit starting this summer. So you're running up against a little bit lighter supply. Demand has picked up, and some of our data for September is showing a little bit of firming out there across the country, and especially in some of those areas that had been softer this summer.
How does inventory factor into that?
Yeah, I mean, it is the key dynamic, right? We talked a lot about affordability. That's constraining the demand side of the house, but prices, at least over the last 2.5 years, have been really driven by inventory. And some of those markets that had moved into significant surpluses this summer, West Coast, southern region of the country, had softened. Those areas that have no supply, even here in the Northeast, we talked about New York City. It is very unaffordable here, but there's not enough supply and it continues to push price higher. So that inventory dynamic is the key dynamic in the market right now.
Interesting. We also understand that you're seeing new trends when it comes to borrower profiles. What can you share there?
Yeah, a couple of different things. One, credit scores continue to be very strong, right? So it's higher credit quality borrowers that are going out there buying, also refinancing in the market, which is pretty typical. The one that catches my eye a little bit more is DTIs, right? The share of your monthly income needed to make those housing and other related expenses, they have come down. For refinancers, they're at a 3.5-year low, suggesting that as rates have eased, it's taking some of the pressure off homeowners that had bought at the peak of home prices, the peak of interest rates. They're able to refinance right now and improve their cash flows. Same on the purchase side of the house. We mentioned affordability is at its best level in 2.5 years. DTIs on the purchase side at their best level in 2.5 years. Good sign for homeowners, maybe a good sign for credit risk in the market as well.
We are early on in the fourth quarter of 2025. Yeah. What a year it's been. It's flown by in many ways, but what are the trends that you're seeing shaping up here early in the fourth quarter?
Yeah, I think inventory is key for the housing market, right? What do sellers do from this point forward, and do we see that inventory get bought down and things firm up a little bit out there in the housing market? That is one. The second is delinquency rates, right? There's a lot of conversation around the labor market right now. What does that do to mortgage performance and borrowers' ability to make their mortgage payment? We've seen it hold up pretty well. but a lot of eyes on that as we move into the fourth quarter of this year and into 2026.
For anyone who is on the sideline, building up those funds for a down payment, maybe waiting for rates to drop a little bit and perhaps inventory to ease, is there a time horizon that you think they can look to, right, if they're planning?
Yeah, I think that is the key question in the market. Obviously, it looks better now than it has over the last 2.5 years. So things are improving for the buy side. I think you're seeing more folks jump into the market right now. If you look at futures for 30-year rates, it suggests that things could continue to improve over the next couple of years. And so I think we're on the down stretch for those folks that have been waiting it out and have been struggling. Things are looking better here on the horizon.
All right, very good. Andy Walden here with me in studio. He's ICE's head of mortgage and housing market research. Andy, always a pleasure. Thanks so much.
Thanks, Kristen. Appreciate you.
Yep.